Hello, welcome back. So, the Chinese market, along with Alibaba, of course, and all the well known Chinese stocks, is crashing again today. It's doing its usual thing. And stocks like JD, Alibaba, NEO, for instance, is actually down like 10%. They are getting decimated once more. And Alibaba is approaching its 52-week low, actually. Right now, sitting at a very low price, $83. And you will see here that this is like a 10, actually less than 10, for a price to free cash flow ratio, which is basically outrageous. But, right now, based on what is happening in the world and based on the current situation, pretty much in terms of politics and what is happening in China, we are still having the Chinese market basically getting absolutely decimated. Now, if you take a look at our stock news here, the stock news module, you will see some interesting information about Chinese stocks, for example, rocked ahead of Fed's interest rate decision. Now, of course, Jerome Powell basically absolutely crushed the markets with his remarks about extra pain being anticipated for investors. And you will see here the impending rate hikes are a potential issue causing all this pain. Of course, there's lots more happening in the world and lots more uncertainty, and this is what the market doesn't like at all. Now, in this video, I wanted to take a little bit of a look at a couple of very interesting articles here talking about Alibaba and the difference in behavior between Charlie Munger and Li Lu. There is a divergence here, and I also wanted to talk a little bit about Alibaba and Tencent, which is reminiscent of Google in 2009. Very interesting articles here that I wanted to take a little bit of a look at. As you will see here in regards to this article, there are some risks being mentioned, for example, the VIE structure, for which we have talked about in the past, because buying Chinese shares like Alibaba has to go through a VIE structure, which can be a little bit risky potentially. There is also the delisting issue here. That is another type of risk. There's also the thing that China is doing, basically killing their own economy, at least for now. And so this article kind of talks about the investment thesis of these two giants. Like Charlie Munger, for example, has described Li Lu as a Chinese Warren Buffett, as you'll see here. And in case you don't know of Li Lu, he's part of the Himalayan capital, and that's a very well-known capital management pretty much company. You will see here Li Lu's current holdings in his Himalaya capital management are shown in the chart below. And you'll see that he's holding a lot of Micron here, very interesting. Bank of America, Alphabet, Google, which I also hold and I like a lot. Berkshire, Apple, and again, extra Alphabet over here. Now, I'll probably make a separate video in which I'm going to be talking about these holdings over here and kind of analyze the portfolio. This is some videos that are going to be upcoming. But you will see here, this is some interesting remarks here. And what he said over here, that is, as you'll see here, Li Lu is what he said over here. And Li Lu's following Civilization 2.5 theory offers a more fundamental explanation of the underlying cause. And you will see he believes China is at an interim stage between Civilization 2.0 and 3.0, let's call it 2.5. They have come a long way, but still have a long road ahead here. The cost of deviation is very high. If you have a good understanding of China's culture, people, and history, you will agree that China will forge forward. This is particularly the case now that you have a better understanding of the essence of modern civilization. There's almost no chance of China leaving the common market, which is interesting to see. And the probability of China hanging its market rules is also very small. So what Li Lu is actually saying here, that there's a transition phase that could cause some pain for a while, but he doesn't really think that China will actually escape the free market principles pretty much and basically adhere to that. This is what I feel as well. This is what I think is going to be happening, and I do anticipate that the Chinese market will have some booming upcoming, actually, maybe in some time from now, of course, maybe in a year or so. Who knows? We don't know the exact time frame, but this is what it looks like, I feel. Now you will see here the other thing, what Munger has been doing at this very nice chart. As the stock price has been going down, Alibaba that is, he has been buying more and more, doubling down here, and he halved his position over here, which was surprising to me, but remember that he has quadrupled his position, and he's still holding twice as much as he held at these levels over here. Very interesting to see, and again, this article talks about all the risks that we have talked about in the past. So there's not much of a point to talking about this again. But what I wanted to talk about is this interesting article here, which talks about Google in 2009, where the company was actually priced at about $11 or so, 10 to 11 bucks, and it makes a case of a tenfold increase for the stock price of the company, which is what has happened to Google since then, since 2009. Google has actually gone up about 10 times since that price that they had. And you will see here pretty much the comparison, which is very, very interesting to see. The P ratio of Tencent, Alibaba, and Google here in 2009, that is, it's making a comparison. It used to be like 11.6 over here. Alibaba, for instance, is 11.8, and Tencent is 13.1. Tencent is another company that I'm starting to like even more right now as the stock market is going down and down. Price to sale of 2.2 sales, price to sales 2.2, and Alibaba is actually lower. Price to book 3.4, Alibaba is also lower. Return on equity is about similar here, and net margins, Google is a little bit more, as you would expect, of course. Very, very interesting to see. Again, there was a meltdown back then. You'll see that in 2009, the American financial system appeared to be melting down. Businesses and households were capitulating and entering bankruptcy, while major banks like Lehman Brothers went under. You may remember what has happened then if you were alive and if you were actually following the news, and you kind of knew what the stock market crash was all about, and generally speaking, the economic crash back then. And we may be looking, as you'll see here, at a similar situation where, likewise in 2022, the real estate bubble in China appears to be slowly imploding. Many estimate that China's enormous property developer Evergrande Group could also go under, and as you can understand, this can cause a significant issue with the Chinese economy, which is already absolutely getting decimated from the Chinese government themselves. So we could be seeing some sort of a capitulation event, following this kind of imploding, for instance, from Evergrande Group potentially, or something similar. And as you'll see, Chinese citizens are heavily invested in real estate and structurally underinvested in stocks, which sounds like a prime opportunity for basically destroying the real estate market for a while, dropping prices, having people sell, and then buy, because then you buy for cheap. This is what typically happens with assets that are overpriced, or assets that are owned from average people, who tend to sell when prices go down. And typically smart money tends to accumulate when prices go down. It's the opposite thing, of course, as you can understand. And of course, the article pretty much here talks about the economic moats that these companies are. Tencent and Alibaba enjoy market-leading positions in China, for instance, and they believe that the author, that is, that these companies have key assets here that ties all things together. Of course, understandably, there is some fear and uncertainty that we do know about, and everything that has been happening in the world geopolitically these days really causes some fear in the hearts of investors, understandably so. But again, in the long run, I think these kinds of companies are going to be massive leaders and are going to be doing extremely well in the future. Now, you will see that the expected returns that the author is making a case for here, you will see what they are, like annualized returns of like 20% or 18%. That's 20% for Alibaba and 18% for Tencent, annualized that is. And this is why the price target is like for $500 over here. I think this is actually fair. I do think that this is something that could rather easily happen for a company like Alibaba in 2032. I do myself expect this kind of growth to be eventually happening. So I really don't think this is far from what is going to be happening from with Alibaba and Tencent as well. This is again another company that I feel it's going to be doing very well. And I really need to make another video about Tencent. It's been a while since I last talked about it. And this is what the article was basically talking about here. I thought it was very interesting to discuss because it has many similarities with Google, as you saw. And it presents a potential 10x upside situation, which you can understand is, there is some risk. We do know about all the risks. We have been discussing them pretty much the whole year, but the rewards can be pretty nice over here. And this is why Alibaba is one of my core holdings here, and yeah, it has been a little bit of a pain, although my cost basis is not that high. It's something like 94 or so. But still, there has been some pain for a lot of people. But I think that holding in the long run is gonna be very, very rewarding for companies of this sort like Alibaba and Tencent. Thanks for watching. Leave a comment below. Tell me what you think about the current situation in China, and I'll see you in the very next video. Thanks for watching again. Bye bye for now.